Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, December 4th, 2020. And here are our top stories. Americans are snapping up homes, and NASDAQ says to diversify, disclose, or delist. Well, joining me now to discuss this and more is Devin Banerjee. He's Senior Financial Services Editor for LinkedIn. He's also the editor of the This Week in Finance newsletter, which you can find on the LinkedIn platform. Devin, thanks so much for joining us this morning. Great to see you again.
Absolutely, Jeff. You too.
So let's jump in. Americans are apparently buying up new homes at a rapid pace, and there's not a glut of homes on the market anymore.
That's right, Jeff. It is the bright spot in the American economy right now. The housing market is just on fire. I'm going to home in on California for a couple of minutes, which is considered by many a proxy for what happens in the national housing market. Jeff, the median home price in California in September set a new record at about $712,000. It's the fourth straight month of consecutive new record highs in that median home price being set in California. And for many people, it's kind of a head scratcher because there is so much talk at the same time of an exodus out of high cost of living areas like California toward places like Texas or Nevada or Arizona or Oregon. But as the chief economist at Moody's, Mark Zandi, told me, in this pandemic, nothing has been more surprising, positively surprising, than the housing market. So what's really behind this trend? You mentioned a couple of factors. It's really a combination of several factors. At the top of that list, Jeff, is the lowest cost of borrowing on record, of course. We saw back in March, the Federal Reserve lower its benchmark interest rate to that 0 to 0.25% band. And of course, while the Fed does not directly set mortgage rates, the ripple effects of a move in its benchmark rate indirectly lead lenders to reduce the cost of consumer borrowing for products like mortgages. So the average rate on a 30-year fixed mortgage now stands at about 2.7%. As I said, that's the lowest in 50 years of Freddie Mac record keeping. And of course, that leads would-be home buyers to race out and try to take advantage of this low cost of borrowing to snap up homes. You pair that demand with another factor that you mentioned, Jeff, which is constrained supply in housing. There's simply not enough new homes being built or being built at a pace or with the willingness of states and local jurisdictions to keep up with this demand. Another important factor, zooming out a bit more, is this K-shaped recovery or this K-shaped bifurcation that you and I have been talking about. At the top leg of that K are people who were doing well before the pandemic and doing even better. These are the ones with the capacity and the willingness to go out and try to buy homes. That lower leg of the K is really where we see a lot of this unemployment data really come from that we talk about. And that kind of resolves this head scratching that we're doing about how can these two trends be occurring at the same time. The unemployment picture is really skewed toward that lower leg of the K. It's low wage earners. Those folks are already likely to be renters and maybe not so likely to be out looking for homes. So those doing even better than they were before the pandemic are the ones out looking for homes. And the last factor I'll mention, Jeff, is this booming fintech ecosystem. You and I spoke about this back in September. There are just so many easier, more accessible ways for folks, especially this millennial generation, which is entering its prime spending years and also inheriting a lot more from the prior generation. And so these folks are looking for homes, they're having families. It's allowing them easier, more ready access to mortgages and to finding houses, this booming fintech ecosystem. So you take all those factors combined, and then it's not so surprising that the housing market is on fire to this extent.
Yeah, Devin, I think about those first-time home buyers out there, and they seem to be, you mentioned the lower income folks, and obviously that's important. We want to get those people re-employed, and if they want to buy a home, they should have the opportunity to buy a home. But what about first-time home buyers? Because, obviously this, if you own a home, I think you to some extent have a real advantage in terms of getting another mortgage. You've already got equity built up, theoretically, if you're paying your mortgage to buy a new home. But those that do not yet own a home are really disadvantaged here.
That's right. I mean, a lot of this increase in demand paired with the supply constraint means there are bidding wars, being sparked in almost every single home buying process. It has been quite difficult for those first-time home buyers. But again, a lot of those are in this millennial generation, which you and I, Jeff, spoke about a couple weeks ago, is experiencing several really big tailwinds right now. And those two that I mentioned are entering their prime earning years, and then also the pace of inheritance from their baby boomer generation, who unfortunately are passing away at an increasing rate. So that wealth is being transferred, and they are in many cases in a position now to go out and afford that home.
The other thing that I was been reading is, even if we wanted to build, so I'm sure home builders are excited to see the demand really perk up. But even if they wanted to hire workers to build the homes, there's a competition for wages. So in effect, you've got to be able to find people to actually build the home. Number one, you got to find workers. And two, now you're competing with other businesses. Maybe they're doing commercial construction. Maybe they decide they don't want to do that, and they want to go into retail or some other vocation. That's another concern as well, is having the resources by which to actually construct homes.
That's a really important point, Jeff. The competition for resources, and then the other huge bucket that I'll mention, which it's hard to generalize across local jurisdictions, but there's a lot of politics, especially here in California, where I'm based, around what kind of housing to build, whether it's commercial, whether it's residential, then whether it's affordable residential housing or single family homes or luxury homes. The politics is really, and there's some great reporting, and there's some great books out recently, actually, in the past 12 to 18 months about this problem in California and why housing is so difficult to increase in supply. The last thing I'll mention, Jeff, just for investors out there, there's been some interesting reporting this week among credit investors, those debt investors who own mortgages, and it has been kind of an unpleasant time for them, driven in large part by what's called prepayments, or for us, the borrowers, we sometimes refer to, we know it as refinancing. As mortgage rates have fallen, homeowners are trying to lock in those lower rates. They take out a new loan and pay back early their previous loans that were paying a higher rate to those investors, to those holders of those mortgages. Then also, as we take out loans at lower rates, our cash flow profile is often better. We're paying less in interest, and sometimes we're incentivized to even prepay principal back early on that new loan. And so those investors, those holders of the mortgages, are losing out on that long-term interest stream. And so it's been an interesting time for credit investors. A lot of them are lamenting this situation, but of course, what's bad for somebody is often good for us, the homeowners and the borrowers. So,
yeah, and I think the case also could be made when you look at commercial real estate. That banks. I think we were talking with Deidre Woolard yesterday on the program about this. That banks are actually suffering because tenants are walking away from their leases, that they may have shuttered their business. They may decide they need a smaller footprint. There's a lot at play here. And I guess the takeaway here, Devin, is it's not just one thing or one factor that moves an economy along or moves a segment of the economy along. It's often a lot of things. Well, Devin, I want to go to a very quick break. When we come back, we'll talk about the NASDAQ's decision to either diversify, disclose, or delist companies that don't follow suit. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Hi folks, Joe Namath here, and if you're on Medicare, this is important. You're now entitled to eliminate co-pays and get dental care, dentures, eyeglasses, prescription coverage, in-home aids, unlimited transportation, and home-delivered meals, all at no additional cost. Plus, your zip code may have coverage with the Give Back benefit that adds money back to your Social Security check every month. Look, with the uncertainty of the virus and vaccines, you need to get everything you're entitled to. Here's the bottom line. Call to get significant benefits at no additional cost and see if your zip code has coverage with the Give Back benefit. Millions of people have trusted the Medicare Coverage Helpline. You can too. Call now. It's free.
Call 1-800-924-3920. That's 1-800-924-3920.
Welcome back. We're talking to Devin Banerjee of LinkedIn. Devin, thanks as always for staying with us this morning.
Absolutely, Jeff. Always happy to.
Yeah, a really interesting story. This is another interesting story. We often talk about sustainability, diversification, diversity, ESG. The NASDAQ has decided to mandate, and maybe that's the right word, to either have its companies listed on its exchange to either diversify, disclose their diversification, or delist. What can you tell us here about this story?
That's absolutely right, Jeff. I think it's been one of the most popular items, not just on LinkedIn, but in the financial community this week. A lot of buzz about it. And again, it's coming from NASDAQ, the stock exchange operator, really putting a stake in the ground on diversity in the boardroom with a diversify or delist mandate. You're right. They've asked the SEC for permission this week to adopt a new requirement for the roughly 3,250 companies listed on the main U.S. NASDAQ exchange. And that requirement is to have at least one woman and one diverse director on the boards of the companies on the exchange, as well as to report data on board diversity, otherwise to be delisted. Now, some details about this policy. NASDAQ is proposing a 2 to 4 year window, depending on the size of each company. So a 2 to 4 year window after SEC approval for these changes to be made. And what I found interesting, Jeff, is that disclosure is really the priority here in NASDAQ's eyes. Companies not disclosing their diversity information face that potential delisting. Those companies that do disclose their diversity information and their progress along diversity metrics, but don't meet those standards of the board, don't face delisting, but they will have to publicly explain why they haven't been able to meet those standards yet. So an interesting weighting more on the disclosure of diversity metrics and the progress toward those diversity targets. Now, what's also interesting is that NASDAQ has looked over the past 6 months at these 3,250 companies on its main U.S. exchange and found, Jeff, that more than 75% of them do not currently meet these proposed requirements. So if implemented and if approved by the SEC, these companies are going to have to, a lot of these companies are going to have to make changes quite quickly in that 2 to 4 year time frame. Also interesting, Adina Friedman, the CEO of NASDAQ, said they've actually lobbied the SEC to make this this diversity disclosure requirement a rule for all companies. The SEC regulates all public companies as well as private companies. And Adina Friedman, who's the CEO of NASDAQ, but actually was previously the CFO of the Carlyle Group, one of the largest private equity companies that owns dozens of private companies. She says she thinks it's very important for the SEC to consider not just this specific NASDAQ exchange rule, but applying this rule to all companies. It actually kind of shows the potential clout of stock exchange operators. We talk a lot about, and the financial community talks a lot about, the clout of big asset owners and institutional investors. This really raises the question or the possibility, Jeff, that stock exchange operators can put these stakes in the ground on other hot button important issues like the other ESG issues or like climate change. So it's going to be really, really interesting to see how the SEC responds to this. They're opening what's called a comment period where they solicit public comments, and then the commissioners will make a decision after that.
Yeah, I'm really interested to see, when you put a stake in the ground, I'm interested to see what the market, and I'm not talking about the stock market, I'm talking about the market of, technically, NASDAQ has traditionally been like technology based, types of companies. I'm wondering how the market will respond. The other thing, Devin, that I wanted to pick up on is we talked about disclosure and being able to provide that information. And this is something that I think when you look at ESG, you look at sustainability, I had a conversation with Bob Colley last Saturday of Colley ESG about this issue. It's really, you can have the best ideas in the world in terms of sustainability and ESG and diversity, and you can have good ideas about diversification, I might add. But what's really important is that you disclose this information, because how do you benchmark it, Devin? And I think that's going to be really key. How do you get these companies, and I know there are organizations like the CFA Institute and others that are developing standards. I think Morningstar has a rating system, but that's going to be really key here so that people can really peel back the onion and learn as much as possible.
Yeah, agreeing on the metrics is such an important issue, especially in this whole booming realm of ESG investing, as you and I have talked about. Agreeing on what the benchmarks and the metrics and the comparables are across companies is absolutely necessary for investors to be able to easily screen potential investments. And so we talked about this the other day, you and I, Jeff, with David Swenson, the chief investment officer at the Yale Endowment, putting out that letter to the money managers to which Yale allocates its money, talking about disclosing and tracking the diversity among the investment professionals at those managers. But again, a lot of the response was what are the metrics? How do we track? How do we get our investment staff to self-identify in terms of being diverse or not diverse, et cetera? What is also important, though, to mention, Jeff, is that this NASDAQ proposed rule is actually coming alongside some other important developments this year, some of which you and I have talked about. One important one to note is Goldman Sachs' recent announcement that they will not help a company go public if that company doesn't have at least one diverse board member. Also, the state of California has that new law now in place requiring companies headquartered in the state to have a minimum number of minority directors on the board. And it's also coming, as I just mentioned, big institutional investors like endowments and sovereign wealth funds, et cetera, are pushing for more diversity disclosure under that banner of ESG. So there is this momentum and this feeling like specific rules are being put in place, and that this is kind of a tidal wave that cannot be stopped at this point.
Yeah, it's certainly going to be interesting to see how this plays out with the NASDAQ. And I'm really interested in the comment period for the SEC that you mentioned on these new rules. Devin, great stories as always. Great to see you. Enjoy the rest of your week, and we'll talk to you again very soon.
Sounds good, Jeff. Take care.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Then drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, so much more, check out our daily newsletter, The Morning Pulse. Don't forget, we're back again tomorrow with a very special interview and a look at some of our best segments for the week on BRN Weekly. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the change.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.